audio later. And okay. All right. Go ahead, Lynn. Take it away.
All right. Thank you, everyone, for attending or logging into our director's cut for December. As Allison said, we're talking about October production. That's just the normal production and reporting cycle. So we're always 2 months out. Went with a Star Wars theme this month, but it's not the last of. It's the return of the Bakken. I think the numbers are going to speak louder than anything I could, and it's really pretty remarkable. Starting with oil production, 78,000 barrel a day month-over-month increase. That is the largest month-over-month increase we've ever had in North Dakota. So it's an indicator of the strength behind the industry and the number of drilling rigs and frac crews that are working. And looking at a little bit of the anecdotal data for the follow-up months, November and December, they look very strong as well. So it may, weather permitting, it's always a risk in the wintertime in North Dakota, but weather permitting, we may be starting to look at record numbers again before too long. We certainly are at record numbers in the natural gas production. First month ever that North Dakota produced more than 2 BCF a day. And we've talked some about the stress that's placing on infrastructure and the stress that we anticipate coming about in the next year. So a big concern of mine, and I briefed the Industrial Commission on it yesterday on the concern about infrastructure keeping up with gas production. And the governor talked about what can we do to promote this so that we attract capital and we make sure that we keep growing our natural gas infrastructure. So it's definitely on the minds of the policymakers what to do with all this natural gas that we're producing. Also set an all-time high for producing wells. So we're now at just under 12,200 unconventional wells, 14,250 total wells producing in the state. There's still some downside risk on oil prices. If you look at the NYMEX strip, you can see that the market's looking at this and saying, well, these stronger prices are really being propped up by OPEC production cuts and by a growing world economy and growing world demand. So those two factors present downside risk, because the only direction really either one of those could go would be to see a surplus of production. If for some reason OPEC broke ranks or their coalition and their cuts fell apart, or we have some type of economic problems in Asia or in the rest of the world. Europe is still struggling with the Brexit. So both of those present a price downside risk. And I think that's why you're seeing caution on the part of the oil companies. Talking with both the large and small players in the North Dakota Bakken play, they're talking about adding maybe 3 to 5 rigs next year at the most. There just really is not a lot of urge to add rigs. One of the drags on that is that it seems like the ideal frac crew to rig ratio is 3 to 5. So 3 frac crews can keep up with 5 drilling rigs. And that's just about exactly where we are. We're at 53 drilling rigs and 30 frac crews. So we're just keeping up. And you can see that in the waiting on completion numbers. They just don't go down. It's hard for me to believe that this is the new normal, to have 850 to 900 wells waiting on completion. But unless something changes in terms of the ability to get workers or workforce and add frac crews, this may become the new normal, to have almost 900 wells waiting on completion. We know that the normal is 300 to 400, but this is double that. And so we'll be watching that. Also, the inactive well count just really has not dropped. And I find that also quite interesting. Workforce problems and the ability to deploy workover rigs to return inactive wells to production have been a problem, and now we're going into winter, and that is certainly not an optimum time to return inactive wells. So it looks like, at least for the next few months, that 1,500 inactive wells is going to be the new normal. And so we're having to change our thinking in terms of how many wells there are, basically waiting in the wings that could be relatively quickly brought on, hydraulically fractured or brought on with a workover rig. But it looks like the new normals are much higher than historical numbers. One of the numbers that have disappeared from the director's cut and is back again is future wells on Fort Berthold. So you can see that the Fort Berthold activity pretty much mirrored statewide activity, but there was a lot of work on Fort Berthold over the last year looking at well densities. And so I knew the number wasn't correct, and so about 2 or 3 months ago, I took it off the director's cut. I think we know enough now to say that the well density on Fort Berthold is going to be more than double what we were using before. And so a lot more potential future wells on the reservation lands than what we had shown, 3, 4, 6 months ago, because well densities have gotten tighter. And because the Fort Berthold geology is very good, Middle Bakken, upper first bench of the Three Forks and second bench, and in some areas, the third bench of the Three Forks. So there's going to be more wells anticipated on Fort Berthold than we saw in the past. And that kind of leads me into my last point, which is flaring. The oil to gas price ratio has gotten really high again. Oil is now at a ratio of 21-to-1 versus natural gas. And so the market is not incentivized to reduce flaring. That having been said, natural gas prices and natural gas liquid prices are now in the profitable range. So they've gone from, in 2014, 15, and the first half of 2016, maybe all of 2016, natural gas and natural gas liquid prices were a negative. So people lost money gathering and processing natural gas. That's no longer the case. So there is profit there. And a big part of our push is going to be to let people know that natural gas production is increasing rapidly and going to increase rapidly to much larger numbers than what were projected back in 2012 when the Bentech study was done. And that gathering and processing that gas is profitable, so there's a reason to come here and spend money on gas infrastructure. Just met the goal, the Bakken statewide goal, 85% gathering. And so again, that's, as gas production grows, that's going to be a difficult thing to maintain. I just checked with the production analysts. We have 10 companies or operators that did not meet the goal. And so we're evaluating them to see if any kind of regulatory action is necessary. But with the holidays and everything, it'll probably be the end of the month before we can make those decisions. I think the biggest story in that is that on the trust lands within Fort Berthold, gas capture was only 69%, way, way below goal. And so I know the governor is having some conversations with the tribal chairman about could we work together to work with the Department of Interior and eliminate some of these multiple steps in getting right-of-ways approved on Fort Berthold. It appears like the number one problem with gas gathering on Fort Berthold, especially on trust lands, is right-of-ways. Both the tribe and the Bureau of Indian Affairs look at those right-of-way things at least 3 times. And so there's multiple steps there. And so the governor's going to be talking to the tribal chairman about a joint effort to see if we can get some things delegated and reduce the time that it takes to get right-of-ways in place. So we just met the goal. That's the good news. 10 operators didn't. That's the bad news for them. But as we move forward and we grow gas production, especially going into winter, it's going to be hard to maintain that goal. On the upside, we do have a new plant that just came online, I believe, and there's an expansion of that plant planned, which will come online in early 19, and there's another expansion of the Wild Basin plant that'll come on in the third or fourth quarter of 2018. So it looks like we can get there, but it's going to be a real foot race to maintain our gas capture goals. Great month. Back to the way the Bakken was, growing and rapidly growing, and infrastructure racing to keep up. So with that, I guess we'll take some questions.
Okay. What are your thoughts on companies possibly shutting in production on their own due to flaring volumes? Or you touched it a little bit about how we're evaluating those 10 companies, but do you see anybody doing their own shutting in?
Well, there's some indication, and Justin's done some analysis on this. There's some strong indication that in McKenzie County, companies have been self-restricting production. We're seeing much longer sustained production from brand new wells in McKenzie County. Not the super high IP rates or initial production rates with very rapid decline, but lower initial production rates, partially attributed to the new paradigm for hydraulic fracturing, which is lots and lots of water and sand, and then bringing the wells on somewhat slower to make sure that you don't crush the sand proppant, and that you maintain all that money that you spent on the hydraulic fracturing job. But also, I think companies are self-restricting. It looks like in the data that they're self-restricting production. We don't get reports of who's choking their wells back. You know, that's not something that we can identify a specific company or well, but the overall data from McKenzie County shows that people are choking their wells back and sustaining high production longer, but not as high as, you know, not the 2,000 and 3,000 barrel a day initial production rates, but 1,000 and 800 barrel a day initial production rates. So there's a fair amount of that. It's an interesting challenge because on the one hand, having too much gas production, you know, some folks have talked about, is that going to limit growth in oil production? It could, if we don't play our cards right. What we hope to do as policymakers and working together with industry, like we typically do in North Dakota, is get this out there as an investment opportunity. That here's an opportunity to invest several billion more dollars in North Dakota infrastructure, and because gas prices and NGL prices are better, make money on those investments.
Okay, we'll stick to flaring. You know, there are probably a few folks on this call that were not around in 2014. So could you maybe explain about how the targets and the order is for Bakken percentages? And there's a follow-up to that, but maybe explain that, and then what's the process of actually going through the restrictions or getting restricted? Okay. It's a big one.
I'll take a shot at that.
I should have sent the LinkedIn story.
Yeah. So, of course, what we all know is that I believe it was September of 2013, flaring got to 36% of North Dakota's gas production. We were only capturing 64%. Now, historically, we had captured 95 to 98% of all of our conventional natural gas. It was located in a finite oil field, and the infrastructure came in and was built out, and the gas got gathered and sent to a gas plant. And so we were used to gathering, 95 to 98% of the gas. But the Bakken oil field is so much larger and covered so many areas where there wasn't any of that pipeline infrastructure that the market quickly outran the gas gathering infrastructure. And at that time, oil prices were 26 to 30 times natural gas prices. So again, the market just did not incentivize gas capture. In fact, the economics showed that on a well, out of a dollar's worth of profit on a well, 97 cents came from the oil and 3 cents from the gas. So what the market incentivized was flaring the gas, and that's what we saw happening. So the commission held hearings and gathered information from the operators and the general public about what we could do different in terms of gas regulation and flaring regulation. The biggest item that came out of it, of everything, was that we needed to force gas capture plants, that the operators who were drilling oil and gas wells were not telling the midstream, the gatherers and processors, what their plans were. They would just simply drill a well, turn it on, and then call for a pipe. And months and months later, maybe a pipe would show up and it wouldn't be the right size. So we started with gas capture plants, and I think that's made a huge difference. But I think we've probably seen all the benefit from that. As long as we continue to enforce it, all the benefit we're going to get. So what other incentives are there? We also incorporated, we issued an order then in March or April of 2014, which set up a production restriction sort of an operation. And it said, here are the gas capture goals. You have to meet these goals as an individual company. And one of the things that the companies wanted was the flexibility to do what we were just talking about. Could I self-restrict wells over here in a county where my gas capture is really good, and then offset an area over here where I'm waiting for pipelines to come and I really don't have any control, but I need to drill some leases and do some work over here so I can flare more than the goal over here, but offset it by more than meeting the goal on this other side. So we set it up to where the first cut we take is, did your company meet the goal on a statewide basis? If it did, we just don't look any deeper. We don't look at individual wells or fields or counties. And then we next go to the county and say, did your company meet the goals in this county? If so, we don't look any deeper into that county. We only look at the counties where you missed the goal. If you miss the goal in a county, then we look at individual fields, and we take fields where you met the goal off the table, and then we begin to look at individual wells. And in the end, if you haven't been able to self-restrict and get to a point where you could meet the goals, then we will restrict production on individual wells down to 100 barrels of oil a day. Now, if a well's producing less than 100 barrels of oil a day, it doesn't get restricted. And that's kind of the number we haven't really explained yet, so I'm going to take a shot at that. Why 100 barrels a day? That number came not out of this set of hearings, but out of previous work that the commission had done. Remember, the gas flaring rules and regulations had been in place since 1988. And so there was a lot of history there. And economically, we could go back and look at the economics of all of the cases where companies had come to us and asked us to lift the flaring restrictions on a certain well or a field. And what it really came down to was it takes 100 barrels a day, or basically 100,000 cubic feet a day from a well to justify building a mile of pipeline to reach that well. That's kind of the minimum number. And so if we limited people to below that, what we were going to do was counteract the incentive for people to invest in pipelines. And so that was the rationale behind that, was allow them to produce at a minimum rate that would demonstrate to the gas gathering company that it would be economic to lay at least a mile of pipeline to get to that well. And so that's how the limits and restrictions work. There is flexibility in there. So if a gas plant has a bunch of downtime, say a compressor station goes down or something, they can issue what's called a force majeure letter, and that will exempt that gas for that period of time from the restrictions and from the calculations. That's probably the main one that gets used.
So just to follow up on it, do you have a rough idea about how short we are in terms of infrastructure? I'm thinking specifically gas processing plants.
That's a better question probably for Justin. He's been doing those projections, and I'm going to defer that to him, but yes, we do. I think he's got a pretty good handle on when we're going to run out of room, and just how difficult the situation is, how much additional processing and gathering we need in addition to natural gas liquid transportation, and it's not very far in the future. It's very close.
Could you clarify the month-over-month increase? Is that the percentage that's the month-over-month increase, or the volume?
No, it's the volume. Okay. It's the absolute volume. The 78,000 barrels a day is the largest volume increase we've ever seen. Okay. And interestingly enough, and I'm glad Justin looked this up, I want to give him credit. He said it was a year ago was the #2 increase. So October seems to be a good month for North Dakota production.
And that was the state, correct? Not just the Bakken?
Correct. That's statewide.
Okay. Any questions? Go ahead.
Just following up on that, what do you attribute that big jump for October?
Our best estimate visiting with companies is that they finally got to the number of frac crews that it takes to keep up with the rig count. So we had been lagging pretty significantly up until the third quarter of this year. And sometime in that July, August, September timeframe, they got to 30 frac crews. And so with full deployment of all those frac crews and the ability to get the gas into a pipeline system, they took advantage of that. And also the very nice weather in October. That's one of the nicest months. I didn't really comment on the weather, but there was a lot of windy days in October. Yeah, so that should have, you maybe held that back, and maybe it did. It may have been larger had we not had 15 days when it was too windy to frac. But it's dominantly because of getting enough frac crews and getting them trained, so that they're really up to speed now.
When you mentioned the rig count increasing by 3 to 5, was that individual operators were increasing it by that, or the overall?
That seems to be the total industry-wide. So we're at 53. It doesn't look like industry plans to push to 60 next year. It looks like they plan to stay in the mid to upper 50s with the rig count. That's always, of course, oil price dependent. But for example, just this week, one of our peer Bakken players announced that they went out and spent a very large sum of money to buy Permian acreage. And so that's going to pull investment away from North Dakota to Texas.
Okay, thank you. Asked a frac question. Sorry, I was trying to read. Questions on frac crews. Why aren't we seeing that number go up? Is it still a hiring problem?
Yeah, it's predominantly workforce. The frac companies that I talked to, and there's a half a dozen of them, they've been holding job fairs more than once a month, and they're having a hard time hiring qualified applicants, people with a CDL who are fluent in English and have the computer skills to get through the application process and get on board. So getting the qualified people and getting them trained has been a real struggle.
Okay, could another potential limiting factor be that companies aren't completing them so they have flexibility to respond to prices? It seems like they could bring production on a lot quicker from DUCs than just drilling new wells.
Interesting question, and I think there is some of that. As the oil prices have increased of recent, companies have been locking in what's called hedges. They've been hedging their future oil production. And so I think there is somewhat of a factor that they don't want to frack these uncompleted wells and bring them on until they've locked in higher oil prices. So they've been watching the market to try to hedge at the very best price that they could get over the next 2 years. And so as we've seen the price increase kind of relax, we may see companies more interested in fracking the uncompleted wells. But they're certainly using that to manage their cash flow. And that's why I talked about we may have to come to terms with the fact that 800 or 900 duct wells is the new normal, is that companies are going to use that to manage cash flow. Rather than being a factor of we just don't want to frack at this price, they're managing cash flow and flaring with those completions.
My question is regarding the USGS survey that they're going to be doing.
Yes.
Is there a correlation, or would there be a correlation for the survey of oil production in the future, and whether this is going to be a good or bad outcome? Are we going to see increase or decrease?
Well, there certainly is a correlation. And I'm sorry? Oh, I got to repeat the question. Yes. Okay. So the question was the upcoming USGS survey and what that might mean for North Dakota production and workforce and activity and all of those things. I think we were happy to see that the timing of the survey is yet to be set because we feel like at the Department of Mineral Resources, we got a lot of work to do before USGS comes to do a basin survey again. One of the concerns is that numbers could potentially go down because what they publish is undiscovered oil reserves. And so if there's a lot of drilling and discovery and not much new geology work in the meantime, those numbers can actually drop. USGS numbers are very important. We do a lot of the same research here in North Dakota, but that's kind of like the underwriter laboratory stamp of approval that actually causes venture capitalists and markets to respond and send money to an oil play. So it's a very important study and important number. What we've been looking at since the announcement came out was that the 2010 study that USGS did here, so it's now 7 years old, it identified 11 source rock or oil and gas source beds in the Williston Basin. It identified 11. We've gone in and compared that to what our geologists recognize, and our geologists think that we've got 23. So there's a lot of source rock that has yet to be incorporated into a USGS study. So between now and when this study kicks off, our geologists are going to be focusing on what do we have in terms of core data, rock evaluation data, information on those other 12 source beds, so we can put in the hands of the USGS the information they need to break those up into assessment units and actually add them into the resource study that they do. So we think the numbers will go up just from the factor that there's a dozen source beds that haven't been included in the previous studies. But we have a lot of work to do to make sure that that happens.
Okay.
If those numbers go up, it clearly will attract more capital to North Dakota. It will increase activity, increase production, encourage people to invest in North Dakota.
So I've got a little handout that we put together in case this came up. And do you want to just maybe explain what these 2 pages are? I've
Sure.
got it on the screen for some people, and I can send this if you guys want it when we're done.
Yeah, so the first page is from the 2010 USGS study, and it's got a lot of pretty colors on it. The right-hand side identifies what they evaluated in terms of reservoirs that had contained oil that was undiscovered in North Dakota. The column that you see on kind of the second column over, the colored boxes there are where the USGS saw that there were source rocks in the basin. And if you count those, you come up with 11. And so they looked at 11 different layers of rock that when they get hot enough, long enough, they generate oil or natural gas. The second page is from Ed Murphy, the state geologist's last quarterly report to the Industrial Commission. And what you see there is the number of published studies and things that we've done. That's the stars. But the thing to focus on is that left-hand column. The tan colored boxes on that left-hand column are oil source rocks that we've identified from core in North Dakota. There are 19 of them. The top 3 should be colored. I colored them green. Are they green on the ones that you handed out? Nope. Okay. The top 3 I colored with a green highlighter because those are natural gas source beds. And so that's how we come up with the 23. So if you compare page 1 to page 2, what you can see is that the previous USGS evaluations for undiscovered resources have left out a lot of potential source rock in the Williston Basin. And so we want to focus on making sure that all the core data we have on all 23 and everything that we have gets in front of the USGS.
Top 4.
Top 4. I said 3?
Yep.
Okay. Top 4.
You can do that math. 19 and 3 is not 23.
19 and 3 is 22. Very good. So yeah, thanks for asking about that, Heidi. It's a very important study. It's really critical that we help USGS get this right. And we've learned a great deal about the rocks in the Williston Basin through the Bakken and Tyler and Spearfish activity that we want to share with them.
Okay, well, that is 31 minutes. So actually they got you for 32 because we started at 1:59. So.
Overtime.
And everybody, I am getting your messages that want this handout, so I will make sure we get it to you. I see 3 so far, so I will get that to you, and I'm gonna pull up Mr. Kringstad's stuff. I think it went to sleep. Justin.
No, I just turned it. Second. And so remind me there, I do have another image that we can pull up when this is done.
To answer the question.
Yeah.
Mhm.
Yeah. It's just what a radio person wants to hear. I've got a good chart to point this
Are you
out.
surprised?
Oh, it's going to the top of the chart.
Oh, that's great. Love it.
All right.
All right,
Perfect.
JK, go ahead.
Well, good afternoon, everyone. Justin Kringstad, Director of the North Dakota Pipeline Authority. We'll get right into the material. Alice, are you ready to
Yeah, I'm good.
follow along? Okay. So a number of months ago, I had mentioned and brought up kind of a more formal analysis of what was happening with pricing as it relates to Dakota Access being in service. So I wanted to start off my time here and just give an updated look at what has been happening with Dakota Access, the pricing discounts in North Dakota, its impact on the pricing scheme in the region. And so what you'll see here on slide 2 is an update for the months of June through October. And so this was the months that DAPL was in commercial service. You'll notice that when we compare it to the 2016, the pre-DAPL timeframe, North Dakota was averaging about $7.71 below West Texas Intermediate, the WTI benchmark. Since that time, that June to October, North Dakota's averaged $5 below WTI. So not quite a $3 improvement, but as you can see here, $2.71. And what that equates to when you figure out how many taxable barrels and the tax rate for the state of North Dakota, you'll see at the bottom in bold, $43.5 million of additional revenue as compared to a 2016 type discount for the state. And so again, the prices have improved. We're continuing to see that going forward. The month of October, specifically September and October, pricing did improve very dramatically, even than what we'd seen in the early months of commercial service for that system. The month of October, we were at $3.73 below WTI for the state of North Dakota. So that was a significant improvement over what we've seen in the past. So we'll keep an eye on that. I'm still in the belief that this is going to continue to take some time for the ebbs and flows of the market to reach a new normal. So we'll all keep our eyes on this and continue to adjust going forward. And so now moving into the more traditional set of updates. Production, you've heard about North Dakota, no changes, no significant changes in the neighboring states that we share infrastructure with. This is just on slide 4, a graphical analysis of what's taking place month to month. That top in green is our oil production, month over month changes. And as Lynn alluded to, this was the highest month. And then you'll notice exactly a year ago, that other spike up. What is a little bit unique in my mind compared to even a year ago, we've had now 4 months in a row of production growth. Whereas if we look at back a year ago, we were playing a little bit of catch up from a couple of down months. And so I do read into this even a little bit more than I did a year ago as we sat here. And same thing with the natural gas. I know this month was not the highest natural gas increase month over month, but I think it's significant when we look at the peak, which was earlier this winter. Again, that was coming out of some blizzard situations we were having in December. So again, I look at this month as even more significant than some of the past increases because of what's been taking place around it activity-wise. When we look at how the oil's been moving out of the region, just some minor shifts. We have seen some changes in just the way the crude's been flowing in and out outside of the region. I'll just move on to slide 6 for a little bit maybe better clarification. Some continued growth in the market share on the pipeline systems. Rail has stayed fairly steady, and we did see a decrease in the amount of barrels being trucked up into Canada. And I'll touch on that in just a second. So if I forget to talk about those Canadian truck imports, exports, someone remind me at the end. So on slide 7, just a very small estimated increase in the amount of crude by rail out of the region, even though we saw a significant increase in production. I believe that the pipeline systems have been absorbing that production growth out of the region. When we look at the September figures, so again, the EIA, with the way they report their rail movements, they're a month behind us. So this is September rail movements out of the region. EIA was estimating almost exclusive movements to the West Coast. And so just very few barrels remaining to be shipped to the East Coast. We'll see if this gets updated. I know the month of September, we were still dealing with some of the hurricane aftermath and some of the movements that we do know were scheduled to go east. Whether or not they're fully accounted for here or if there will be any type of revisions going forward. But by and large, long term, I expect to see that purple line stay in the 90+% at least from what we see in today's market. Pricing in that September timeframe, again, no major changes. We're continuing to see East, West, and Gulf Coast, those marketplaces that are tied to the waterborne, the more world type market scenarios, having the highest priced regions and destinations. And now with the Gulf Coast having access with Dakota access, looking at that LLS pricing, that may give us some hints as to what's happening in North Dakota with the discount. LLS, which stands for Louisiana Light Sweet, was trading $5.50 higher than the West Texas pricing. And so for North Dakota, historically, we've always used Cushing as kind of our benchmark and what we look at to understand North Dakota's pricing. Now with direct connection to the Gulf, we always want to keep our eyes now on what's happening with some of those other light sweet crude grains in the Gulf Coast, because that does trickle back then in North Dakota. And I think we are seeing that in some of the discount numbers and the improvements we've seen in that arena. And so this part, the imports, exports. And so we saw a pretty significant increase in the amount of Canadian crude coming in North Dakota, and we saw a modest decrease in the amount of North Dakota oil going north. And I think that has to do with some of the stronger pricing we've seen in the region. It would make sense for some of those Canadian barrels, if North Dakota has a strong price environment, for those barrels to come into the state and try and commingle and get involved with our marketing scenario. And then the decrease in exports. Again, you have to have a pretty strong reason to want to move your crude north of the border by truck, rather than keeping it in a strong price environment like we've seen in the September-October timeframe for the state. So we'll keep an eye on that and see if that continues to hold true. And then, as Lynn alluded to, fairly steady September to October on the flaring side of things. No change at all on the percentages of why that gas is being flared. Identical September to October baskets of of gas flared from wells that do have a pipeline connection versus wells that do not have a pipeline connection. And again, as I just noted, no change month to month, September to October. And then gas connection, so how quickly are the gas gathering companies connecting the wells out in the field? We did see new producing wells slightly outpace new well connections. So again, that's something we want to watch and see how quickly the gathering industry is keeping up with the producing community. So again, 1 month, things ebb and flow pretty quickly, but we'll want to keep an eye on that for any type of longer term type trends and what that may mean to the industry that's again working to capture that gas and get it moved to the processing facilities. And then last but not least, just a quick snapshot of what's happened on the natural gas liquids. This is a month behind, so if you remember, September we did have gas production down, and we saw NGL production down as well. When we do see the October numbers next month, obviously with the amount of gas that's being captured and processed, we'll likely hit new highs on the natural gas liquids production as well. Should we address your question quickly? Okay. Yeah. I'm gonna pull up another. So I apologize for those of you, Allison does not have this slide. Those of you on the webinar, there was a question earlier about North Dakota's gas processing capabilities and our ability to keep up with this. What you're looking at on the screen, this is 1 month old, so this does not have the October gas production figures, but this is a near-term look at historic gas capture, gas flaring, and then my forecasts, case 1, which is that red line going forward, case 2 is that gray line going forward, and then the tan colored boxes, what you're looking at, that is gas processing plant capacity in the state, and then in blue is suspended capacity. There was a couple of plants that had planned.
Why don't you stand up and point to it?
Yeah.
It's really hard to see on the screen.
And so so if we followed this case 1 scenario, October production was even higher, so this was going to push this red line up even further. In order to meet this gas capture 88%, we would have to have this green plus sign, that much gas being processed. We do have theoretically enough processing plant capacity. We don't have a whole lot of excess in the near term. And as we start looking longer term, that's when we're going to have to start seeing some investments for that 3 to 5 year type time frame. Any new projects are likely going to take at least a couple of years to get put together, permitted, constructed. And so there's a very high level of interest right now from the industry to say, okay, this 2019 and beyond time frame, what do we need to have in place? So as of right now, unless we continue to see some production growth like we saw in October, they may be able to continue to meet those needs with the current processing capabilities, but it's going to continue to be challenging. We're going to have to see creative solutions with gas being moved around the region. There may be one county that is theoretically short on gas processing capacity, so they may have to move those molecules to a different plant in a different county in order to continue to get that gas put into the system. Does that help? Okay. All right, and that's all I have for any formal comments. I'd be glad to answer any questions there might be.
Could you comment on the Bentech study? Are you looking at having that updated, and why would it be important to update it?
Yeah, so what happened in 2012, we were really just significantly less knowledge base than what we have today as far as how the wells perform. So there was a couple major goals of that study back in 2012. The first was to understand gas oil ratios and how those change over time. And I would say that study was absolutely correct. They forecasted that we're going to see growing gas oil ratios over time. We've seen that come to light as the region has progressed. Another big question we wanted answered at that time was gas takeaway capacity, and what does that look like for North Dakota long term? Do we have enough gas takeaway out of the region, and how does North Dakota gas compete with other gas sources? And so right now, no formal decisions have been made of whether or not another study is warranted. I think that there are just a number of folks that are looking at, what type of questions are still lingering that we can get some outside expertise to help answer, whether that's on the takeaway capacity side, whether it's on the marketing side for North Dakota Gas and some of the opportunities there, whether it's more reservoir level analysis of how the wells are performing so that better forecasts can be created. Those are questions that all of us grapple with each day, whether it's the state or whether it's the industry itself. So I think right now there's just a lot of the folks just kind of brainstorming of what type of questions everyone has and how much value there is and looking at it in more detail.
Nothing on
No.
over.
All right. Perfect. Okay, well, thank you very much.
Thank you.